Hello, this is Mike Swanson of Wall Street Window, and I got a very special guest today. I'm speaking with Ike Iossif, who runs the website marketviews.tv. How you doing today, Ike?
I'm doing well, Mike. How about yourself?
Oh, I'm doing good, and we speak periodically, and you often will give me an update on what your money flow indicators for the S&P 500 are showing, and I'm very curious because of what's going on in the stock market, especially after the news of the vaccine the other week, the positive test results, and the market really had a big gap up, and we've seen a lot of rotation and activity in the market, but then this week it hasn't really been doing much. And you also sent me another chart with the advanced decline volume line too. We'll look at that one first.
Well, Mike, we excuse me. We look at price, and also we want to look at the internals, because the internals sometimes give us an X-ray of what is really happening. One of these internals is the cumulative volume, and most people are familiar with it. The way it is calculated is very simple. You take the up volume, you deduct the down volume, and the result you add it to yesterday's numbers. And then so you get the cumulative volume. Pretty much the same thing as the AD line for issues, but instead of up and down issues, we'll look at up and down value. And the first chart shows just that, the cumulative volume during the rally which started on November 3rd. Now, I have a additional way of looking at up and down volume, and you and I have discussed it many times all the years that we've known each other, because I have come to the conclusion that cumulative volume is a valuable tool, but also we need to look at the dollar value of the up and down volume. The reason is, if somebody places an order to buy 1,000 shares of a $10 stock, that investor is making a $10,000 commitment. If someone is placing an order to buy 1,000 shares of a $1,000 stock, that investor is making $1 million commitment. Both commitments involve the same numbers of shares. 1,000 shares of a $10 stock, 1,000 shares of a $1,000 stock, but the dollar value is different. I think any reasonable person would agree with me that we should give more weight to the $1 million commitment than to $10,000 commitment. So I have devised an indicator which is ratio adjusted, therefore it's not static, it's dynamic, and it looks at the dollar value of the up volume in relation to the total value, to the total value of volume, and the dollar value of the down value, of the down volumes, I'm sorry, in relation to the total value of volume.
So I'm looking at it now. I'm assuming then that the red line is the down volume and the black line is the up volume.
It's the dollar value of the
dollar volume. I mean,
yeah. The black line is the dollar value of the up volume, and the red line is the dollar value of the down.
So it's like you're taking the volume times the price on various things to
kind of
sort of, yeah.
And it gives us, also a more accurate picture of where people are putting their money. Okay. Now the interesting thing is this: the 50% level, the equilibrium level, that's the level at which the dollar value of the up volume and the dollar value of the down volume are the same. 50% of total value of the total dollar value of volume. Okay?
Well, I remember we spoke right near the low of early October, and they were about at the even point, both of them, the 50% point.
Yeah, and what I said back then was that when we get down to the equilibrium point, that is a point of inflection. Because at that point, only two things can happen. Either we get a bounce and the market rises, or we get a negative crossover, meaning the dollar value of the up volume goes below 50%, the dollar value of the down volume goes above 50%, and we get a decline. What is interesting to me is this. If you look at both charts together, the previous chart, which is the cumulative volume, we can see that during the rally, the indicator rose from 12,750 up to almost 13,750. So we had a 1,000 unit rise. That makes sense. Now, to put it in exact numbers, I will tell you this. The up volume between 11/2 and 11/13 for the S&P was 11,662,870,000 shares. The down volume was 7,245,440,000 shares. So the net difference, okay, was a positive 4,417,430 shares. So the obvious question is this. If we had 4 billion shares more rising, then how come the dollar value of the declining shares and the dollar value of the rising shares were at equilibrium? And from that, we get a very interesting conclusion. I hope I do not bore our listeners, and I'm going to give you a very oversimplified example, but actually it's quite clear in making the point. Why it happened, how it happens, and what it means. Now, suppose one sold 1,000 shares of ABC stock at $100 per share. And when he placed the order had the ask and the bid, he placed the order as a market, so actually happened on a downtick. It means the 1,000 shares will be counted as minus 1,000 in calculating the cumulative value, okay? So will be 100,000 value of the transaction in my calculations.
Okay.
Now let's say simultaneously the same person, after selling 1,000 shares of ABC stock at $100 per share, he bought 10,000 shares of XYZ stock at $10 per share on an uptick. What does that mean? It means the 10,000 shares will be counted as plus 10,000 when it comes to calculating the cumulative volume. So will the 10,000 value of the transaction in dollars in my calculations, okay? So what does that mean? It means that although the cumulative volume will show a net change of plus 9,000 units, the net inflows, outflows will show zero change because the 100,000 sell transaction was equally offset by the $100,000 buy transaction. Okay? To put it in a different way, let's say somebody sold one share of Netflix at $470 per share. and he used the proceeds to buy 11 shares of GM at $42 per share.
Okay.
The one share that was sold, okay, will count as -1. The the 10 shares that were bought will count as +10. So the net difference will be what? +9 shares when it comes to the cumulative volume. But if you look at the cash balance in your account, practically there will be no difference because the money that you spent to buy the 11 GM shares came from selling the one Netflix share, okay? So to make a long story short, and I hope I haven't confused anybody, when we see the cumulative volume rising by 1,000 units, but the dollar value of the up and down volume being equal, what it means is we have witnessed a massive rotation. People are selling high price stocks, which happens to be high tech, high momentum stocks, and they're using the proceeds to rotate into cyclical stocks.
Well, I've seen that. Like with the we've seen days where the Nasdaq is down and the Russell 2000 is up.
Yeah, the dollar value of the up and down volume confirms exactly that. Now,
What are the implications of that, though, going forward for the market?
I'm glad you asked me this because that was going to be my next point, okay? Usually, when you get such a large-scale rotation, and this has been one of the biggest I have ever seen because think about this. We had almost a 12.5% rally in the S&P from 3240 up to 3650, and yet the dollar value of the up volume and the dollar value of the down volume were roughly equal, despite the 12.5% rally. That is a massive rotation out of high momentum, high tech, and cyclical stocks. Usually, and the emphasis is on usually, nothing in this business is always 100%, but most of the time, this kind of large-scale rotation does not get concluded in just 6 weeks, because this has been going on since early October. As we speak now, it's November 20th, so we're talking about 6-7 weeks. Usually, this kind of massive rotation plays out over several months. So I would imagine that probably the 3200, 3250 is the support zone for the range, and the 3650, 3675 is the resistance zones for the trading range. Something that also I think is supportive of the idea that somewhere between 3650 and 3675 will get a pullback and back towards either the middle of the zone or the low end of the zone are these two factors. First of all, sentiment as of last week, by all measures, has gotten over bullish. Whether you look at NAIM or AAII or Investor Intelligence, for the first time since February, they have all gotten aligned and over bullish. The next thing is how far the S&P is expanded from its 200-week moving average. As we speak right now, the S&P is 30% above its 200-week moving average. You can go back 20, 30 years, and you will see that the only other time we were that far above the 200-week moving average was in February of 2020, and in January of 2018, and again in, I believe, January of 2000, and again in October of, I'm sorry, in August of 2007. So sentiment, technical overextension, and the large-scale rotation, all three suggest that the odds favor that we are in a trending range. Evidence of a catalyst, the market will stay confined between 3,200 and 3,250 and 3,650, 3,675.
Well, that I think I would argue that this diminishes the chance of a giant or big sizable correction. I mean, just a 20% pullback from the Labor Day high seems unlikely, even if there is continued bad news, which is right in front of your face every day when it comes to the economy and the virus situation. It doesn't seem like it's going to matter with this technical setup.
Well, I will say this to you. I believe it was sometime in 1994, although it may have been earlier, but I believe it was 1994. Barron's had an article and a cover page, the title of which was, "What We Need is a Good Recession." The implication was that the market had gone sideways in 1994. And what the article was saying is that what we need is some bad news so the Federal Reserve can lower rates and the market can go up. The same mentality multiplied by 10 times exists now.
For sure.
All bad news are considered good news because, gee, the worse things get, the more stimulus you will get, the more monetary help from the Fed will get. So it is unlikely that the market will break below 3,200 unless there is something that is completely out of, unless there's some sort of a black swan event, okay? That is something that you cannot predict. I mean, I do not know what that event, may be. But in the absence of something catastrophic, bad news from the worsening COVID situation, I don't think is going to dissuade the bulls. I think looking out 6-9 months from now, the biggest threat to the bulls is actually things getting better. And I'm going to go back to an interview that you and I did in December of 2017. And back then, we were discussing the passage of the legislation regarding the tax cuts. The market had risen throughout 2017, and I asked you rhetorically, well, if everybody's positioned for the tax cuts, who's going to buy after we do get them? And in fact, we got a sell-off. Everybody right now is positioned and will probably keep on positioning themselves for the eventual recovery. So when we do have confirming signs of that recovery, I think that is what will be a real threat to the bull market. Having said all that, I'm only going to add one last point. The 3,200 level for several months now has been a key support level. And when you look at the inflows, outflows indicator, I have also pointed out in the past, we did an interview back in September, that this is a point of inflection. If for some reasons, which I do not know what they may be, the 3,250, 3,200 level is violated, then indeed we can get a much more severe decline.
Well, right now, 3146 is where the 200-day moving average is, and 3248, basically 3250, is exactly where the 150-day moving average is, which they tend to act as solid support.
Yeah, exactly. So I mean, it would have to take some sort of a catastrophic event to break these two support levels. You agree?
Mm-hmm. Yeah, for sure. I think
And
so.
that's what the money flows are saying too. But also, I think it would take some sort of a super miraculous event for the S&P to break above 3650, 3675 right at this moment.
Yeah, it seems like we're set up for a trading range, and the indicators bear that out.
Yeah, I agree. One of, if I may add, something else that I will pay close attention to is the behavior of the dollar. I do think what the dollar does over the next few weeks could have an impact on not only on the equities but on several other markets. So I would keep a close eye on the dollar.
Well, as we're speaking, it's just like hovering above the low of September.
Yeah,
But it's been doing that for really since then, a couple months, just sitting there. But
there's lots of hesitation, but we don't have either a clear break or a clear upside reversal.
hmm
So I
well,
think it's worth keeping an eye on it.
as we wrap up, I'd just like to tell people to go to your website, marketviews.tv, and subscribe to your service. They get it, not only the interviews you do for other people, but updates such as this, on a consistent basis. And this is really important information.
Thank you, Mike.
Thank you.